Hello, everybody, and welcome to this 2024 Q2 quarterly investor update. I'm Jeppe Kirk Bonde, the most copied popular investor on eToro. If you want to use this presentation in any way, please go ahead and read the disclaimer here at the bottom very carefully. So the agenda for this presentation is I'll talk a bit about my background, then my investment strategy, then exactly what I have in the portfolio right now, and then finally I'll go through the many questions that I've received. So one of the reasons more than 20,000 people are copying my investments on eToro is that since 2013, I've had an average annual return on investments of 25%, which is really better than anyone you could fairly compare with, and with a better return to risk profile than most you could fairly compare with. My background is from management consulting. I spent most of my career in London. Now I live in Dubai. I'm originally from Denmark. And as a management consultant, I advise some of the world's largest banks, tech companies, companies in aerospace and defense, and many different industries. And one of the products I worked the most with was valuation. So calculating how much is a company really worth. And then as I was doing that, I was making more money than I was spending. So I wanted to invest my money. And then I compared all the different investment platforms on, how good is the app, the website, what products are available, what are the fees like, and so forth, and weighted all those factors. And then eToro came out on top. And so I started investing on eToro. And then as that continued to go very well, more and more people started copying me, initially mostly my friends and family, and then more and more people. And in 2018, I then quit management consulting to focus only on managing my investment portfolio on eToro. And since 2019, I've been pretty much number one the whole time. And today, more than 23,600 people copy my portfolio for a combined more than $74 million. Now, I don't do everything on my own. I have a very good assistant who helps me with core analysis. I have a good network of experts that I trust. So if I invest in something, I must either myself be an expert in it or know someone who is, as otherwise I can't get the really good insights in an effective way. Then I get really strong support from eToro. Whenever I have any questions or concerns, I more or less know exactly who to reach out to and then get immediate help. Then I subscribe to the best data providers and IT tools so that anything that can be reasonably automated is automated for me. And finally, I'll highlight my three favorite experts, which are my brothers. One of them, he is the CEO for a successful company in the marketing and advertising space. One of them is an economist for the Danish Ministry of Finance. And the last one has a degree in computer science focused on AI and now works mostly with the charity in the effective altruism space. So if I have any questions or concerns within these areas, then they are my go-to guys. Then my investment strategy is based on some principles that have been there all along, and they continue to be here. I focus on macroeconomics, so evaluating what kind of growth rates do I think different pockets of the global capital markets can have. I focus on mega trends, so these are trends that can grow by more than 10% per year for more than 10 years. Then I focus on fundamentals, which means actually valuing companies. What is this company really worth? I do that by looking at their management teams, their products, their services. What is it like to be an employee there, to be one of their customers? What's their competition like? What have their financial statements been like historically? What might they be going forward? What are their strategic options? How good are they technologically, and so forth? And all of that is with an eye on evaluating under what kind of scenarios can they have, what kind of profits year after year after year. And then I add all of that up with the discounting for time to get a total valuation of the company. That's how much I think this company is worth. And then I compare that with the price and invest in companies where I evaluate the value of the company is a lot higher than the price, usually because there's something I've seen in the company that I think others have not seen in this company. Then I focus on the long term. There's a great quote by Benjamin Graham, who was the author of the famous book, The Intelligent Investor, and also sort of Warren Buffett's mentor. And he wrote that in the short term, the market is a weighing machine. In the short term, the market is a voting machine. In the long term, a weighing machine. And that means that in the short term, it can be important what other people think. But in the long term, if a company becomes very big and profitable, then it'll be great if you have bought a big piece of that company at a low price. And I have the patience to wait around for that. And effectively, if you want to manage an investment portfolio or a business or your life, you can really think about it better and model things better if you're able to remove all of the things that will not really matter 10 years from now, to really focus in on the things that will matter in the long term. And then if you're right about those things, then 10 years later, then you will have overall made a lot higher return than being part of the masses that are, trying to add one more analysis to a short-term event that's already over-analyzed and where there's not much opportunity to really differentiate yourself or to make a different, unique analysis. Then I focus on risk management. I'm currently invested in 59 different assets across many different countries, many different industries. So that's diversification. Then I hedge, meaning that I find different factors where some companies can do well if this factor goes in that direction. But if that happens, other companies will do poorly. And then by having those companies together in the portfolio, I can neutralize the effects of that factor. Then I stress test. So I look how my portfolio can potentially perform in many different scenarios. So if this thing happens together with this and that thing, then how do I think my portfolio would fare? But what about if this thing happens together with that thing? And then if my portfolio looks like it wouldn't do too well if those things were to happen, then I see what kind of changes to the portfolio I can do that'll mitigate that. Then I focus on keeping the fees low. So I don't do any excessive trading. I don't do any day trading. I don't trade any high fee instruments, and I don't use any leverage. And I pay the same fees as anyone who copies me. So by keeping my fees low, copiers keep their fees low. And yeah, keeping the fees low is a great way to squeeze a bit more profitability out of one's portfolio. Then there are some areas where I generally see great opportunities. I like companies that have organic growth. That means they are selling more products or increasing the price of their products by more than the prevailing inflation rate. But it does not include companies that are just growing via acquisitions. So sometimes you have a company that you can read in the annual report that they grew revenue by 2% last year, but actually that's just because they acquired another company. The core business shrank by 4%. So what they've achieved is really not that impressive. Conversely, there are some companies that manage to acquire others at a low price and then create a lot of growth on top of that acquisition. And that growth that comes after the acquisition does count as organic. And yeah, there's some companies that can do that very well. Then I like companies that are resilient, meaning they can do well in not just, a few positive scenarios, but across many different scenarios, especially, by having a very strong balance sheet or having a very strong competitive advantage that's not so easy to take away from them, or potentially a route to build a really hard, sustainable competitive advantage over time. I also like companies that help protect me against specific tail risks. So if this really unfortunate thing were to happen, maybe in that scenario, this particular company would do well. So by having such companies in the portfolio, I can protect myself against various unlikely to happen scenarios that could have a very big impact. Then I like companies that are truly profitable, companies that are creating positive cash flows year after year, and especially if they're able to reinvest those profits into themselves to grow even faster over time. I like companies that have a good new business strategy, primarily because sometimes it means you are paying the price of the old strategy, but you're receiving the value of the new strategy. Now, companies announce a new strategy much more often than they actually have a new strategy. Although there are also times where a company does have a new strategy without really announcing it. It's important for me when I hear of a new strategy that I see there's some real bold steps behind. So for instance, when a Meta changed their strategy, they didn't just change their strategy, they changed their name, and they really ramped up investment in certain categories and so forth. So yeah, that told me they were serious about this new strategy. Then I like companies that make great products. If you are able to understand what are really the key features that make this product much better than the other one, and just again and again make smart purchase decisions for yourself, buying the right product instead of buying the wrong product, then that's sort of one piece of the puzzle that you've fitted in. if you cannot understand companies' products, then it's really difficult to understand the companies themselves. A classic example of failing at that was when Steve Ballmer, the former CEO of Microsoft, he held the first iPhone in his hand, and he was laughing at the iPhone, saying it's too expensive, business customers won't like it, it doesn't have a keyboard, I feel very comfortable about our position. And he was, of course, proven completely wrong by the massive success of the iPhone. But that was an example of holding the blockbuster product in your own hand and simply not being able to identify this as a great product. And many companies or many people have in recent years made the same mistake with Tesla, are probably currently doing it with some of the new AI products and so forth. Finally, I like companies that are mission-driven, not just because I sometimes believe in the mission, but because being mission-driven can be a great way to attract and motivate and retain some of the smartest, most hardworking people without overpaying them. So there are some companies where despite overpaying, they just cannot hold on to the smartest people. And there are other companies that are just magnets for talent. And whether your company is in one end or the other of that spectrum, might not show itself next quarter, but it certainly will show itself in the financial statements a few years down the line. Then my portfolio on eToro is almost entirely invested in stocks. I also have a property that I rent out, and this makes good sense because historically stocks and property have been the best categories for investment, and currently I also think they are the best categories for investment. Stocks as number one. Historically, bonds have been okay. Currently, I don't think bonds are very attractive given the high inflation rates and the interest rates still not being that attractive. Commodities have historically been doing next to nothing, better in the last decades, but not good over the past centuries. And currencies have historically been terrible. I think they're currently terrible and will probably continue to be terrible. So whenever I have a lot of excess cash, I typically want to get it transitioned left in this chart and ideally invested into some stocks. Then there are some factors that really drive global economic growth over the long term. We can look at that by splitting it up into the physical, the social, and the technological realms. So within the physical realms, I like to look at how many trees are in the different countries, how much oil and gas and iron and gold and so forth. I like to look at life, animals, but especially humans. How many people of the different age groups do we have in the different places, and how are those demographics changing over time? The companies that have the right products for the right demographics in the right locations, of course, have an advantage. Then the area in which the most value can be created or destroyed the most quickly is in the social realm. So if you have a document that proves you own a house, or some numbers on a screen that prove you own a stock, or a piece of paper, a US dollar bill, all of these are just social constructs. If we believe in these systems, then they can help us trade with one another, agree with one another, cooperate, and it's in that cooperation that we can create so much value. If we stop believing in these things, then that cooperation stops, and then a lot of value can be lost very quickly. But why does anything really have value? It might seem very obvious to everybody that a house has value. A house is made of bricks or concrete. It's very tangible. So obviously a house has value. But if we humans all wanted to live outside in tents and nobody wanted to live in houses and nobody wanted to look at houses, then houses wouldn't have any value. And sometimes what we humans value changes over time. And that can be coming at a fast pace from a small part of society, or it can be all of society that's slowly changing in a certain direction. And if we do change what we value over time, then the companies that are producing those things will value more in the future, have an advantage. Finally, there's the realm of technology. The most important within this realm are the foundational technological shifts. So a lot of global growth is created when we switch from, technology levels such as from the hunter-gatherer society to the agricultural revolution, then going through the industrial revolution, getting the internal combustion engine, getting into the electronic era, into the computer era, into the internet era, and now entering into the artificial intelligence era. In addition to those, all, across the world in the deepest pits of the R&D labs, we are getting new scientific breakthroughs that can be the basis for growth. And even out in the houses where people are using different products, people are finding new ways to use their products in a little bit better ways. And that also adds up over time. If people are just doing things slightly smarter year after year after year, certainly a long time later, it can really, really change what things look like. So from those big factors really driving global economic growth, we can look at what the world economy looks like today. So in terms of GDP growth, it's generally looking okay, but not great. It's a little bit stagnant in most places, with India being a large notable exception where growth is still quite strong. In terms of unemployment, the unemployment levels are generally lower than before COVID. So that's very positive. It means we are not in this period of brutal cyclical unemployment. And it also means that there are still some structural issues with unemployment that we had before COVID, we had through COVID, and that we still have. And so places like the European Union and India in terms of youth unemployment and so forth have some things to work with there. Interest rates are higher than they have been in recent years, but they're still lower than the historical average. And at the start of this year, many large investment banks said they were pricing in 7 rate cuts through the year. Then that slowly went down. Now, maybe we should not really expect any American rate cuts for the year. And that sort of is very much related to the inflation still being too high. Our target is, of course, 2%, and we are way above that target in everywhere except China, effectively. And there is the economic theory that the last bit of inflation or a bit of excess inflation can be much more difficult to get rid of than some of that, much higher inflation we had just a year ago. Effectively, a lot of inflation that happened from supply crunch and monetary expansion through COVID was able to disappear quite quickly, but a lot more sort of long-term issues with our economy might cause there to be high inflation pressures for a long time. And then that sort of changes what the government and what the central banks can really do in order to stimulate the economy, because they obviously gotta be managing this thing where they don't want to tank the economy, but they cannot let inflation continue at these levels. And so there might be a situation where if inflation stays this high for much too long, then they have to sort of not crash the economy, but deal some severe damage to it just to get inflation under control. And that sort of puts us in a, I would say, historically okay situation, but slightly below okay or slightly below average economic situation. Then there are some mega trends that I've identified as extra interesting. So if a company is riding on the wave of or even driving this mega trend, then it's more likely to be found in my portfolio. So firstly, I like to focus on the nice to haves here in the middle. So when we humans, we have it all, then we like to enjoy ourselves with gaming and fashion, and hopefully in the future, most people can find much more time for these activities. But the nice to haves in a portfolio cannot really stand on their own, as that would be much too risky. They must be complemented by the need to haves. And that's similar to how societies effectively also need to invest in the need to haves, as without the need to haves, without security, there's no way you can really control how your society is going to develop. Others will dictate it to you. So you need to have security. And some of the companies providing the security and energy and other need to haves that we will need going forward are to be found in the portfolio. Finally, there are the enablers and accelerators. So the things that help us do all of these other things faster, better, cheaper. And chief of these, the companies that have made the biggest breakthroughs in artificial intelligence over the past years are to be found in the portfolio, along with the companies that are potentially bringing us the next generation of amazing devices that we'll all be using. Then when you've identified an industry or a group of companies from a specific country or that are tied together on some certain or some theme or trend, then a great way to get an overview of such a group of companies is to look at the multiples. So this is an example of the Magnificent Seven, so the large US tech companies: Microsoft, Apple, Meta, Tesla, Nvidia, Alphabet, and Amazon. And if we look at the top left corner, we can see that all of them have had very good profit margins, but Microsoft, Meta, and Nvidia are quite a bit ahead, and Amazon and Tesla are lagging quite a bit behind. In terms of growth, it's very noticeable that NVIDIA has been growing at an absolutely insane rate. Very, very rarely that you see such a big company growing at such a high rate. Apple, on the other hand, has really stopped growing. The two top charts here, the higher the better, because they're about profitability and growth. But the two bottom charts, the lower the better, because they're effectively about price. So if we look at the bottom left corner, we can see that for every dollar of profit that Microsoft brings in, when we invest in aggregate, we have to pay $30 to be licensed to $1 of those profits. And that's sort of okay, given that they are growing this quite a bit over time. But if we look at Tesla and NVIDIA, we're paying a lot more per dollar of profit. So we only want to pay that much more if we believe they can really grow that profit over time, for instance, either by growing the revenue massively or boosting or maintaining that really solid profit margin in terms of NVIDIA, or boosting the profit margin a lot in terms of Tesla. Finally, in the bottom right corner, we can see that for every dollar of revenue that Microsoft's bringing in, we have to pay $13. So that's sort of sensible, given that we also know that they're getting so much profit out of every dollar of revenue. For NVIDIA, however, we are paying $37 for every dollar of revenue. So we only want to pay that much more if we know that they can maintain or even improve this massive profit margin and growth rate over time. For Amazon, we are only paying $3 for every dollar of revenue, but they're also getting a lot less profit out of every dollar of revenue, and they're not really growing it as much as some of the others. So yeah, that's a great way to get a quick overview of a group of companies. Now, I usually look at a lot of big data tables that are mostly coming in automatically to my models, and some that I update manually that are subjective but numerical. So the ones that are coming in automatically, they come in automatically, and the ones that I manually update, they can be something like how much do I like the CEO's communication skills on a scale from 1 to 10. So that's numerical, but it's subjective, and those can be complemented to help me conduct my continuous valuation of companies. And I can always see all of the different companies ranked by how valuable they are compared to their price and how they fit together risk-wise. And I conduct risk scenarios to evaluate how can my portfolio perform under different scenarios, and how would different potential changes to the portfolio change the risk profile of my portfolio. And with those analysis in terms of risk and valuation, I can make decisions. Now, most of the decisions I make are research decisions. So there's a lot of things I know, there's a lot of things I don't know, and then there are some things I don't know that I should know more about. So then I have a research list, and then I research the things that I think I should know more about that I don't know enough about. And then as I do that research, maybe I learn about a new company. Maybe this changes how I see the world. Maybe this tells me that I need to start acquiring some different kind of data, or the way my data is added up should be changed to reflect this new lesson. So I update my valuation model. This then shows me, maybe that there's another kind of company I should be looking at. Then I research that company, and that teaches me something new. And thus, I constantly research and update my financial models, and then do more research and update my financial models. And then every day I look at how are my valuations telling me that the best investments stack up with what I have in my portfolio. And if the best things to be invested in are not the ones I'm already invested in, then I make the changes that are necessary to bring those in line. So if there's a company that I suddenly think is much better than I did before, and I'm already invested a little bit, maybe I want to invest more in that company. There's a company that I think is great, but the price has caught up, and now the difference between the value and the price is not as great as with some other investment, and there's it makes sense risk-wise, then maybe I get rid of the one and I add the other one. And when you add up all of those investment decisions that I've made over time, then that brings you to my portfolio today. So that's my portfolio right now. You can see that my largest investment is in a TSMC with 5.4% as of this morning. My second largest is in eToro, third largest is Microsoft, and 59 investments in total. And you can always see exactly what I'm invested in the eToro app or on the eToro website. It's available for anybody with an account to see. Then if we compare that with the US economy, we can see that in the US, it's not just one industry that has all the economic activity. There's economic activity in many different industries and great investment opportunities in many different industries. For my portfolio, I'm slightly more invested in technology, in climate and renewable energy, metal and mining, in financial services, and in health and biotech. In terms of geography, if we look at the world, there's a lot of economic activity and stock market cap in North America, Europe, and Asia. My portfolio is slightly proportionally more invested in North America and Europe and slightly less in Asia. And particularly in Asia, I'm underinvested at the moment in China compared to what China makes up of the global stock markets and GDP and so forth. Then that was my initial presentation. Thank you everybody for watching. And now I'll go through the questions that I've received. So firstly, do you plan to stay fully invested or build a cash position? So generally, I want to be fully invested and I don't want to be holding a lot of cash for too long. Sometimes if I've sold a lot of positions on a Friday with the expectation to invest on Monday, I'll be more in cash over the weekend. When there are some big changes, I can be in cash for a little while, but typically it will not be for very long at a time, and it will not be for too much of the portfolio that will be in cash at any given time. If I really didn't like stocks for a while, perhaps I would invest more in commodities and bonds, but I don't think it's very likely that I will just be holding a lot of cash for any extended period of time, mainly because cash is on average just a way to really lose out to the constant growth of the money supply globally. What do you think about gold, silver, copper, and uranium? So I'll just split this question into its 4 sub-questions for each of these 4 commodities. So starting with gold, I really like gold. I think the best way to invest in gold is via the mining companies. It's not by buying physical gold that can get stolen. It's not by buying the ETFs where you just have some gold and that's the gold you have, and then you continue to have that gold, paying a continuous fee every year for someone else to protect the gold. For with one gold fund, for instance, the gold is safely stored in New York under with guards and managed by a very good custodian and so forth. But actually, if you look at you're paying the annual fee and historically commodities haven't done that well, that's not the best way compared to having the mining companies that can produce a lot of gold every year, and you can see what they have in terms of reserves and what kind of exploration they're doing and how much gold they can potentially produce every year. And when you sort of add that up, that's just if you want to have a lot of gold 10 years from now, the cheapest way to get the a big amount of gold is to buy the gold mining companies and let them mine some gold. And effectively, it's a very safe way as well because the gold is safely stored there, mixed in with some rocks in the ground. And so rather than being in a vault in New York, instead you have your gold nicely as reserves you own in the ground, and you can dig it up at a faster rate if you really need to boost the inventory of gold mining companies. Then silver. Silver I like as well, although not as much as gold. Quite often, however, when you're investing in mining companies, these will come together. So you find many mining companies that have a lot of gold, but they also have silver mining. And that's that means that you will have to value both and take them both together. And so for that reason, it's nice that both are good. Silver has an added benefit that there's a sort of a industrial floor under the price of silver. So if suddenly nobody likes silver for whatever reason, it'll still have that industrial utility, whereas gold is very much just a story we tell ourselves. If because we all like gold has value, it doesn't sort of like have any other purpose than that we like to look at it, and it has a wonderful history. Copper, I really like copper, and that's for a completely different reason. And effectively, if we want to have this global electrification with electrical vehicles, lots more things being done via electricity instead of other energy forms, and we want to have so many products that effectively have to have some copper in them, then the total amount of copper we will need will be quite great. In the medium term, short term and medium term, we'll also mine quite a lot of copper. And it's not that copper is completely rare. We, at current production rate, might have something like 100 years worth of copper left in the world. But if we really need, or we get to this point where we need this much copper and we have to keep increasing the production rate, then we will sort of run out of copper. And then I think having a lot of copper is a really good thing to have in those situations, and you're not paying that much for the copper mining companies at the moment. So it's overall a really nice deal, I think. And finally, uranium. I don't like uranium very much. I have I medium like nuclear power in general. I think sort of different types of energy production have some different advantages and some different sort of niches. And for many countries, you want to combine them to sort of, when the wind isn't blowing, maybe the sun is shining, and when neither of those two is happening, at least nuclear is there for the sort of stable production rate. If you're lucky, you can have hydropower, which is sort of the ultimate energy source in that it doesn't produce any greenhouse gases. It's totally flexible. It's relatively cheap as well. So so that's really, it's stable. So that's really the best one if your country happens to have a large piece of water that can be dammed. But otherwise, having some nuclear power can be really good. And then with that nuclear power, of course, you drive some demand for uranium. And with the geopolitical uncertainty, there could be a period of some years where it's more difficult for some countries to get the amount of uranium that they need. And so the companies that already have the facilities to process uranium will do very well. Uranium is not rare, so it's not like gold where it value is really high because it's rare. There are a lot of commodities in this world that are expensive but not rare, and the reason they're expensive is that they're very difficult to process, and so those should really not be thought of at all in the same sort of ballpark as the metals and commodities that are rare. They're just completely distinct investment categories. And uranium prices have come up quite a bit, and potentially one can make a good investment by buying it and holding it and selling it if there's a certain squeeze on uranium at some point. But sort of for an investment for the long term, I prefer to just have nuclear power, not uranium, and then let them have their long-term contracts with the providers of the uranium and hedge their price risk to a certain extent. And then you have a more sort of, I would say, safe base profit level for a portfolio that way. Will you be adding funds soon? So if I add funds, it will at the earliest be at the very start of next year. I'll make an evaluation sort of 3/4 through the year, whether I will do that or not. And if that's the case, then I will, write on eToro that I plan to do that and what everyone should consider doing in response to that. For other people, you don't have to time your own fund additions on eToro to when I do it. If anybody at any time wants to invest more money into the stock market, then at that time you can add funds copying me, or you can pick out some stocks yourself, or however you find it the most suitable way to do it. It doesn't have to be that you're waiting for me to oh, now Jeppe has some extra cash he wants to invest, so now it's the time that I should have some extra cash for me to invest. Like those decisions really have nothing to do with each other. What is the maximum percentage you're willing to invest in a single stock? So there isn't really a rule for that. Hypothetically, if I was investing a lot in a company like Berkshire Hathaway that actually owns many different businesses, I could be comfortable having a larger proportion in that because it's already well diversified. But typically, once a stock reaches about 6% of the portfolio, it becomes very difficult for me to make it risk-wise worthwhile to add further to that position. And at some point, I might also start to have to trim it down to keep it sort of in check. So yeah, for instance, at TSMC, while I think it's an amazing company with a great potential across many scenarios, some bad ones as well, I have less than 6% invested in that, and that's my biggest one. Is it a good idea to invest now? So right now, anybody that has some capital needs to decide how to deploy that capital. And that can mean owning a property or multiple properties, having a large stock portfolio, having some bonds that are providing, a bit of constant interest rate cash for managing one's day-to-day expenses. If you have a lot of cash that's earning a low interest rate in the bank and you won't need this cash for a long time, potentially it can be worthwhile to take some of that and get it invested into some stocks immediately. For people that have a lot of debt, paying a high interest rate on this, potentially it's best to pay off that debt instead of investing in the stock market. For people that have some cash, but they know they will need it for a big upcoming expense within the next few years, potentially it's better to then just say, okay, I will, get a boring, mediocre interest rate for that time, but at least, I won't have this volatility of that part of my portfolio. And yeah, so it's different for different people, but for a lot of people, it's very sensible to have at least some investments in the stock market. Will you adapt your portfolio in case of recession? So that's what I've done in the past. If there are big events in the market, typically I need to do something in the portfolio. When there are big extreme movements in the markets, that also often means if a lot of stocks are falling, potentially some of them shouldn't actually have been falling that much, and then I might change my portfolio in response to that. If a recession is expected to be a medium recession, but I think it's not going to be as bad, or it's going to be much worse, that can then change. The prices have gone in this direction, but I think they should go much more. Then that'll change what I wish to have in my portfolio. In general, some assets that have historically performed well in bad times trade at quite a premium because everybody is aware of that. So if everybody already knows that, taking example, if everybody already knows that gold will protect them in a crisis, then even before the crisis comes, gold will have been bid up so that when the crisis comes, your actual sort of salvation that you got from that gold is much less than it could have been. And so potentially, so you always got to sort of find unique new ways of reducing your risk. Because if you're just trying to find the ways that everybody else has, then you'll just be paying excessively for them. Is it smart to add funds every month? So for many people in many situations, yes. If, for instance, someone is making a fixed salary every month, and every month they have, they're making more than they wish to spend, then it can make sense to take that excess cash every month and just invest that. So you just go in every month, and then you add more funds, and you go in every month and add more funds. For other people, you do that every 3 months. Some people do it once every year. So that really comes down to sort of the exercise of cash management. How much cash do you wish to have set aside, and how much do you wish to have invested? And of course, the quicker money is invested on average, the quicker it'll start to be earning those stock market rates instead of the typical cash negative rate. But yeah, it's got to be balanced with sort of, hypothetically, you could log in every minute, but that'd be very time consuming. So potentially adding funds every 3 months is a good balanced approach for many people. Why does eToro have a copy limit of $100 million? So currently, people are copying my portfolio with a total of more than $74 million. And once it hits 100 million, then I will be copy blocked, meaning that existing copiers can continue as normal, can continue copying, no issues, but new copiers will no longer be allowed to start copying. And that's effectively for a few reasons. One of them is liquidity. So the bigger a portfolio gets, the more difficult it is to make investments into very small companies. So quite often, if I want to invest in a very small company, then it's just blocked. eToro will say that I cannot make this trade because there's not enough shares available in the stock market. So if you're just, if you're investing in Apple, it will not be a problem because there's always more than enough shares of Apple for sale. But for smaller companies, that's not always the case. There's a total amount of stocks that are available for sale, and if you buy all of those shares, then there's no more for sale. And then if we can't buy enough for everybody, then we can't buy, because of course eToro has to execute the trades for me and copiers simultaneously as one big order. Then the other reason, eToro doesn't want to have all of the money that people are investing on eToro following a single person. They like to spread it out over multiple persons, and there are some other reasons as well. What do you think of Alibaba? So I like Alibaba. I think it's a great company. I was not the biggest fan of Jack Ma, so I'm happy that he's not in the picture to an extent. And I'm generally underinvested in China compared to how much China makes up of the world's GDP and the world's stock market cap. But Alibaba is one of the companies that I do have in the portfolio. I think, the e-commerce business is fine, but fundamentally, I think cloud business and new technological offerings are what's going to really deliver the value. And for those, I think it makes sense to at least have a little bit invested in Alibaba. There are, of course, some major geopolitical concerns, which is why I would certainly not have a much too big proportion of my portfolio invested in China at this time. Even though you could say if it wasn't for the geopolitical risks, then compared to the likely profit some of these companies are going to have in the next years, then they look extra attractive. Why do you rarely close positions? So I'm a long-term investor. If I've evaluated a company is worth a lot more than its price, then even if the price goes up by a few percent or my valuation of it goes up or down by a few percent, it won't necessarily change how much I more or less want to have invested in this company. And so it might not be worthwhile for me to pay the fee to make, to sell this and buy this one. Some people, they're buying and selling every day. And as a result, they're just racking up a lot of fees and they're not necessarily performing any better. So you could eventually say that long-term investors perform better in the long term. Short-term investors, they perform worse in the long term, but they don't perform any better in the short term. What is the minimum to invest? So the minimum is currently $1,000. Now eToro can change that amount, but it's currently $1,000. And if you want to add more funds later, then each time one adds funds, it also has to be for a minimum of $1,000. And the maximum, by the way, is $2 million US. Is a stock cheap if its price has declined by 40%? So no, when thinking about whether a stock is cheap or expensive, you should compare what the price is today with what the value of the company is today. You shouldn't compare it with what the price used to be, because that was a different time and you were paying for effectively a different company. If 1 year ago, a company didn't have a blockbuster product, you wouldn't be paying that much for that company. If then, suddenly they made a big scientific revolution and their product got FDA approval and now, it's obvious that they're amazing and then the price has gone up a lot, you're buying something completely different. It's so what the price used to be, that's just a price that people that knew less, they estimated the company to be worth back then. So that's really what the price used to be is an unimportant piece of data. What matters is what the price is now and what the company is worth now based on how it will perform in the future. So I value companies, and if I value a company is if I value a company to be really worth a lot, and I think the price doesn't reflect that, the price is much lower than its value, then it's a cheap stock. But if whether the price is, used to be 3 times higher or 3 times lower, I couldn't care less about that. Do you only do long-term investing? Yes. So I look at a company and I value it based off of how much profits it can deliver every year from now on until forever. And then I buy it with forever in mind. So when I buy a company, it's never with an idea that, well, I will buy this company now, then people are going to bid it up next year and I will sell it to them at a higher price. I buy it because I want to have this company, because at the current price, I think it's worth it. And then I want to own that company and I want to be an owner in that company. And when they pay dividends, I'll be receiving those dividends. And when they buy back their shares, my stake in the company will increase as a result. And then I will be entitled to a part of that company's success in the future. Now, then if the outlook for the company changes, the prices change, other things that I could invest in, become better, then I might decide to sell that stock after a short time period. But that's never the idea when I buy something. Anything I have in the portfolio, I have in there with the idea that I will have this forever. And then every day, if there's anything that I think is not as good as something else, then I will make the trade right then and there. Do you see an opportunity in cannabis stocks again? So I've done very well investing in cannabis in the past. I invested at the very beginning when the first companies came on stock exchanges. Then I sold near the peak and bought back near the bottom. I had a large position in Afria. Then when they merged with Tilray, it put me in a difficult spot because I really liked Afria. I didn't like Tilray. And so I held on to the merged entity, which then declined a lot. But overall, a big success story with me and cannabis stocks. Along the way, I severely changed my long-term outlook for the profit margins for the cannabis industry. And so I think a lot of companies that have racked up a lot of debt and are not making any money at the moment will in the long term face a lot of competition and not have that great profit margins. So even with potential more favorable legislation going forward, some consolidation, some cost improvements and so forth. I think overall they're not the best investment opportunity now, and so yeah, I don't have any cannabis stocks at the moment. But hypothetically, if the legislation goes in the right direction, if there is some consolidation or another sort of change to my outlook for the long-term profitability, without the prices going up or the prices just coming down with the current outlook, then potentially I'll add cannabis to the portfolio again in the future. What is the recommended amount to copy with? So there is not any general recommended amount. It completely depends on the individual person. For some people, it makes sense to invest 10% or 20% of one's salary every month. For other people, it might just be fun to have $1,000 copying just to, sort of, then you can see how it's going and you can sort of have the joy of being an investor without it maybe being, a giant part of one's net worth. But yeah, it depends on how much money a person has, how much cash they will need over the next few years, how old you are, how many dependents you have. There's a myriad of personal financial factors that influence the ideal amount someone should be investing. Why are you invested in host hotels and resorts? So effectively, the hotels business is quite cyclical. So companies can be making a lot of money during boom times, but then they will be losing money during sort of severe recessions, like the 2009 financial crisis, or then you had a special case with COVID. But if you add up the good years and the bad years over a long time horizon, sort of the overall amount of money you'll make for good hotels is pretty stable. And so that puts a nice safe block in the portfolio. They specifically host hotels don't put their brand on different hotels. Instead, they own the actual buildings, and then they, for instance, use the Marriott brand, and then but then Marriott doesn't own the hotels; they're actually owned by host hotels. So you have sort of a partial property investment in that regard with this company. And compared to how much profits they can really deliver on this business model over the next many years with some very, very unique properties, it's quite cheap price. So that's why it's one of my relatively large positions. That was all the questions. Thank you very much, everybody, for watching, and thank you for all the questions. And let's have another great quarter.